The following is a presentation of TFNN. It is now time for Trade What You See with your host, Larry Pesavento. Now, Larry Pesavento.
Hi, good afternoon, folks. I'm going to start out the show today with something that is happening as we speak, which is we like to see instead of doing it in past tense. I posted the long-term daily gold chart going back a year to focus on the 61% retracement that we hit back at the 1627 level about 5 days ago. What's important about this chart is, and we were talking about it way back in July when we started making higher bottoms all the way. You'll see the marked 1, 2, 3, 4, and 5. We had 5 higher bottoms along the way, and then we ran up and we made a beautiful Gartley buy pattern that came in at the 1627 per ounce level, and now we've been in the midst of a 6-day rally, and this is a very important day today. And what I'd like to do is to try to show you how I break things down, going from a daily chart down to a 30-minute chart, so that you can get an idea of what we're looking at. Now, what you're going to be seeing now is the first 2 weeks, first 2.5 weeks of January, the price action. You'll see the low that was made down at the 1627 level, and then we rallied up to the 786, and we've been in this zone between 1652 and 1685 for quite some time. But the important thing here is that each of these lows that have happened since January 7th have been higher. The first one came in at the 61% retracement of the previous day. The second one came in at the 61% of the previous day. The third one came in at the 61% of the both previous days. And now what we've had is today's low was a 382 retracement of the low from January the 11th, which was the new moon day, and it was also a 61% retracement off of Monday the 14th. So we had two major numbers coming in at 1673. The reason why that's important is if these cycles are shortening up and the corrections are only going to come down to the 382, all gold needs to do is to get above 1690, and it could really run. I mean, it could have a $50, $60 move very, very fast. Now, on the other side of the coin is if we break below 1673, we could go down and test the 1652 to 1650 level, easy enough. But that's what I try to do, is to look at the daily and then go down to a 30-minute chart to see the same patterns, because they're no different on the 30-minute chart than they are on the dailies. But that's what we're watching in the gold right now. We just need to get above the 1690, and then it could really take off. Of course, that's my opinion, and everybody knows how much opinions are worth. Anyway, the fact that this low today is very important. It went right down to the 1673 level, and as long as that 382 holds, we've got a chance for gold to move, a lot higher. Now, if it does break down, the number to look at is 1650 on the downside. That would be the 61% retracement from January 4th to the high we made just the other day. Now, we're up, 9 days. Those are 9 calendar days. So we're up 6 trading days. So that tells us that we're, very overbought. But by the same token, you can stay overbought in gold for a long period of time. And it is ready to go. If it wants to go today, all it has to do is to pop up above that 1690, and I think you'll see a lot of movement, because this last correction, if that's how much it was 2 days, and if it only comes down to that 382 level at 1673, it means a great deal, in my opinion. If you remember the show that we had Thursday, we were talking about corn, wheat, and beans, with the crop report coming in, and we'll cover this in tomorrow's show. But those numbers held perfectly at the 61% retracement, and there was an not incredibly bullish, but a very, very bullish report on corn, wheat, and beans, and they all rallied substantially. We'll cover that. We'll cover that tomorrow, along with some of the other commodities that we look at. So that's the main thing in gold that we're watching today. We've got an hour to see what happens during that time, and we'll take a look at it from that level. Now, the next chart that I wanted to talk about comes from one of the websites, Zero Hedge, and basically what it is, it shows the stock market, the S&P cash index, going back quite a few years to 2009, and it shows the mathematical relationships that are related to Fibonacci between the highs and the lows. You really should take a look at this chart because it really shows, how accurate some of these numbers are. And it basically what it's trying to tell you is that the market is expanding and contracting in time just like it does in price. Now, I'm a firm believer in the astrology part of it, but remember that these 618 numbers and 786s and all the others are related to the astrological things and cycles anyway. So it doesn't make any difference how you come to these conclusions. The mathematics of the number are there. I mean, you just have to look at it. So the date that they're looking at, and this was the work that was supposed to be done by Tom DeMark. I'm not sure that it was, but they attribute it to him. But they have as January 22nd. Well, we have a holiday on January 21st, and so Tuesday will be the trading day. So we're going to be closed on the 21st. Now, this is the week of the cycle, that I've been watching really close, between the 14th and the 17th. So this is a big time for cycles as far as the astro things that I look at, and it's a pretty big one. And I don't know how big it's going to be, but it's the market is so overbought that it wouldn't take much for to have a really big shakeout in here, just because people are so wildly bullish. And you can certainly see that in the VIX index, which we looked at last week, and just literally, they destroyed that index, and now they're talking about it being useless, which they do all the time when it gets down to these levels. But it seems to be always hanging in there, to give itself another run. So that's the main thing that I wanted to show as far as educational things for today. But there is a couple of things that I think are important from a technical point of view, and that is I'm going to put the New York Stock Exchange Index in here because we have the NYSE Index is certainly into new high grounds. We haven't made new high in the S&P yet or the Dow, and certainly not the NASDAQ, but the NYSE has now made a 1.27 expansion up to the level of 87.12, and there's a couple of gaps on the way up, and if you'll take a look at that chart, you almost never see a gap on the NYSE index. So the gap is enough to scare anybody, at least from the bullish side, from my opinion, and the fact that we're at this 1.27 is also, I think, quite important. So those are the main things that coming into this week that I'm watching. We need to also keep in mind that I think the VIX index has also, we talked about the cycles in that, and there's a 35-day cycle and 70-day cycle in the VIX index that also ends this week, and it went down into new low grounds from going back months and months, and so it's just as oversold now as it was overbought on the New Year's Eve when we had the 618 Gartley sell signal up around 23, and it's gone from 23 to 13, in a matter of 8 or 9 trading days. I mean, that's really a big outlier event. So it's really hard to be bullish in here from a technician's point of view because of the gaps that are there in these indices and the divergences that we're having. We have tremendous divergence in the NASDAQ. It is just lagging behind the stock market, the overall stock market, by quite a bit. The Dow Jones Utilities is lagging far, far behind everything else. And, the Dow Jones Industrials has also not made new highs. The S&P has not made new highs. And, after we had all that bullish enthusiasm from January 2nd and 3rd, the market really hasn't done very much. Now, whether this is going to be a pretty significant high that we have coming in here this week, I don't know. But I feel very comfortable, being short coming into this January 22nd date, which will be Tuesday, because the fact that the market is so overbought and we got all these patterns completing, and we've got the Astro things that are giving us a little boost here. So that's what I'll be looking for, come next Monday, when I think Monday is a holiday. We won't even be here on Monday. So the market will be open on the 22nd. So we'll know more about that. Of course, I'm not on until the next day, the 23rd. So that's the next one that we want to look at is I wanted to show the cash on the S&P on a weekly basis, because we have gone back and we have not taken out the highs from 2007 as yet. We haven't taken out the highs from 2012 as yet. We're very close to that, but we still have not quite done it. We're just a heartbeat away, which I don't think they mean very much on a long-term highs and lows, but we'll see. Anyway, we've got a caller from John in Philadelphia. Are you there, John?
Hello, Larry. Good morning to you.
Good morning. How are you today?
Very good, thanks. Say, Larry, I wanted to check in with you. One market is of interest to me. It's gone absolutely dead for 2 years' time. It's the heating oil market. I'm wondering if you have at your fingertips the weekly charts, and if you could take a look at it and tell me what Larry Pesavento sees in that chart, if anything.
Well, we're probably going to be in a break here pretty soon, John, so stay on if we are. But if you get a chance to, take a look at Tiger TV, you're absolutely correct. We've been in a, very tight trading range for well over 2 years now, between, 331 and 331 a gallon and 253. So it's been really, really tight. It doesn't look like it. It doesn't look bearish. I mean, it looks like it's building a huge base. If it ever gets above, 330 a gallon, I mean, this thing could, explode to the upside, because, after the big run-up, it just went sideways, and that tells you that was accumulation and, not distribution, in my opinion.
Larry, that you just articulated the thought that is running through my head. Is there any way to trade this, in your judgment?
Not that I know of. Now, realize, John, that we got to take a break, John. We got to pay a few bills. John, stay with us. After we come back, we'll talk more about this, okay?
Thank you.
Okay.
Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads. You take a hands-on approach to managing your investments, and whether you're bullish or bearish on Chinese stocks, the ETFs from Direction Shares are there to help you magnify your perspective. bull ETFs for a rising market and bear ETFs for a falling market. Direction Shares gives you the tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foresight Fund Services, LLC. TFNN is proud to partner with Great Panther Silver for another exciting silver coin giveaway. The Great Panther Silver Super Silver Giveaway begins the week of January 28th and we'll be choosing 47 lucky winners. It's free to enter with absolutely no strings attached. Just visit the front page of TFNN.com today to fill out your entry form. Every hour that we're on the air, 9 a.m. to 6 p.m. the week of January 28th, we'll be randomly choosing one lucky winner that will win a silver coin or bar from Great Panther Silver and TFNN. And the final hour of the week, Friday, February 1st, we'll choose 3 lucky winners. That's 47 winners in just 1 week with over $1,000 in silver given away to our loyal listeners. Register today by visiting the front page of TFNN.com. And for more information on Great Panther Silver, you can click on their banner on the front page of TFNN.com or check them out on the NYSE Amex symbol GPL or on the Toronto Stock Exchange symbol GPR.
What type of investor are you? Conservative, moderate, or aggressive? No matter your investor personality, your overall portfolio should reflect your financial goals, time horizon, and your risk tolerance. Help ensure your portfolio is appropriately invested with an asset allocation plan from Morgan Stanley Wealth Management. Simply picking the right stocks is not enough. Research has shown that choosing the right proportions of stocks, bonds, and cash is essential to the success of your long-term investments. Morgan Stanley believes a carefully selected portfolio can lower volatility and increase investment return potential. Find out about what an asset allocation and a Morgan Stanley Wealth Management financial advisor can do for you. Call Angela O'Brien, First Vice President and Financial Planner of the Clearwater, Florida branch at 727-441-6108 today to discuss your personal financial needs. Asset allocation does not assure a profit or protect against loss in declining financial markets. Investments and services are offered through Morgan Stanley Wealth Management, LLC. Member SIPC.
This segment is brought to you by Great Panther Silver. For more information, just click the Great Panther Silver banner on the front page of TFNN.com.
John, are you still there?
Larry, I am indeed. Thank you.
Good. The question you asked, is there any way to tell, what is happening with the accumulation or distribution of the heating oil? And the only way you can do that is if you follow the open interest and the volume, really carefully. And even then, it gets tricky because, a lot of this stuff is done off market and in the cash market. But frankly, I don't look at the news at all. I know you're aware of that, but I really don't look at the news. When I see a spike in something, then I'll turn on the news to see, what's causing the price of heating oil to go up or down. But as far as trying to anticipate, a news event, that's nearly impossible. I just look at the patterns and, figure that the people that are in there trading it know as much about it as anybody else, and that's the way I assume that it works.
Gotcha.
Does that help?
Larry, I'm losing your call. I apologize.
Oh, no, it could be me, John. I only pay my bill every other month, so, that might be the reason. I don't know if this is the month I paid or not. Anyway, thanks for calling in, my friend. Well, unfortunately, we lost a good caller there. Okay, we're going to talk now about the NASDAQ because it has a very interesting pattern within a pattern. We have the big high that was made way back in September, and now we're trading right at the 61% retracement of that high after we made the low down at the new moon and solar eclipse on the 15th of November. We've had the 6-week rally. But what's interesting about this is that we have a 5-wave expanding triangle. In other words, we have waves 1, 2, 3, 4, and 5, and wave 2 exceeds waves 1, wave 3 exceeds wave 2, wave 4 exceeds wave 3, and wave 5 exceeds wave 4, and that sets up like a coil. And this is one of the more popular patterns that Dr. Andrew Lowe did in his book, the Non-Random Walk Down Wall Street, and it is it was also called the Symmetrical Triangle by H.M. Gartley. And it's very interesting that if this is going to be the case, that we should start down, relatively soon. And what we're looking at is this week. The cycle date started on the 14th, and it expands, all the way out to the 17th. And the reason for that is that there's so many cycles that are coming between the 14th and 17th that you have to give it a little bit of room to see if it's actually going to make a turn or not. Now, we also talked when we started the show about Tom DeMark's work on the days of the Fibonacci cycle and how they expand and contract by 61.8%, and that date is also coming due around the 22nd of January. So it'll be interesting to see if this date is going to mean a great deal. The market is very, very overbought, and there's so much complacency out there that I'm expecting something really dramatic to happen. And the reason why is that you have to remember what Thomas Jefferson said about the government. He said any government that can give you anything has the ability to take everything away. So that's the same. All you have to do is change the word government to market, and you've got the same thing. So any market that can give you anything can take it away. And a good example of that, of course, would be, the stock of Apple. And I still believe, we're looking at another big leg down in Apple. I don't think the bottom is in here. I still think the bottom is going to be right around $3.95 a share, sometime around the end of the month if everything works the way it looks like it's working technically. But that tells you a pretty good example of, why listening to fundamentals can get you into a great deal of trouble. If you'll remember, when Apple was making that high, it was getting all kinds of free press because people were lined up in stores all over the United States and in China, waiting for the new iPad or iPhone. I don't know which one it was. And, the market went up there and just stayed there for 4 days at the $700 a share level with the most bullish news that you could ever ask for. And then, it gapped down and, it was all over. So if this, in fact, is the right pattern, we should come in on the 22nd of January, and we should gap down. Well, whether that'll do that or not, I'm not sure, but that's telling us that if it's supposed to work that way, that is the pattern that should happen. In other words, it should have turned, and then when you come in on the 22nd, it should be down. Now, if it's up really big, this cycle is certainly going to be wrong, so you've got to protect yourself. But this is what I'm expecting, and, of course, what you expect sometimes can get you into a lot of trouble. I always use this analogy from Tony Robbins is that, all of your frustration comes from unfulfilled expectations. Okay, we've got to take a break here. 877-927-6648.
Just recently, on December 28th, Market Insight subscribers were advised to go long the QQQ, the NASDAQ 100 ETF, on December 28th at $63.91, and only 2 trading days later, after a huge jump in the markets, Market Insight subscribers were advised to sell the QQQ at $66.64 for a $2.73 or 4.27% profit to start off 2013. At the same time, Tom O'Brien had advised his clients looking for a more leveraged trade that they could have initiated a position in the QLD, the ProShares Ultra QQQ ETF, and over the same 2 trading days, Market Insight subscribers were able to lock in a $4.48 profit or an 8.47% gain in just 1 trade. Get your 2-week free trial to Market Insights today by visiting the front page of TFNN.com. Cancel at any time during your free trial and pay nothing. Don't miss out on the next great trading opportunity in 2013. Act today. Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Recently, Basil Chapman has had some outstanding trades in his newsletter, The Opening Call. Each morning by 9 a.m., Basil uploads his newsletter to the TFNN servers so that his subscribers can access his expert trading advice. Basil gives his take on the direction of key indices and updates any active trades that his subscribers are currently in. Just recently, Basil's subscribers closed out a short position in Chipotle Mexican Grill, CMG, for more than an $86 profit per share, over a 20% gain in just one position. If you'd like to try out Basil Chapman's newsletter, The Opening Call, then visit the front page of TFNN.com and click Trading Newsletters. There you'll find Basil's newsletter, The Opening Call, where you can request a free sample copy. Also, don't miss Basil's program, The Tiger Technicians Hour, Monday through Friday, 11 a.m. Eastern, on TFNN.
Tom O'Brien's weekly newsletter, The Gold Report, has helped subscribers for over 10 years navigate the high-risk world of exploring and producing gold companies. And now's a great time to sign up for a free month-long trial to see the kind of insight that Tom delivers for his subscribers on a weekly basis. Every Monday, Tom O'Brien issues a quick update on the metal market, giving you his take on the HUI, XAU, GLD, dollar, bonds, and much more. Tom follows Monday's update with a full gold report, which is delivered to subscribers Tuesday afternoon with detailed coverage of 24 separate gold or metal stocks, as well as another 10 to 15 stocks that he lets you know are on his potential watch list. Get your month-long free trial to the Gold Report today by visiting the front page of TFNN.com. Don't spend another year navigating the metal markets on your own. Act early in 2013 and make the most of your gold and metal market investments.
This segment is brought to you by Crocodile Gold. For more information, just click the Crocodile Gold banner on the front page of TFNN.com.
Okay, we're back, folks, and I thought we would go to Treasury bond next. When we were on the show last week, we had made the bottom down at the AB equals CD level, and right at that 143 level, and we were looking for a rally to come in around the 146 level, and we're very, very close to that rally right now. And it's really going to be interesting because it's going to tell us that the stock market is one of the two things are going to happen. Either bonds are going to go up, which means the stock market is going to go down, or the bonds are going to go down and the stock market's going to go up. So this is what we're faced with, looking at the bond market, because there's really been a negative correlation between the two, for the past weeks, I guess. But what I'm going to do is I'm into Tiger TV. I'm going to put in the 30-minute Treasury bond chart so that you can see the smaller time frame, the 30 minutes, so you can see the same pattern, that same ABCD pattern that started on January 4th when the bonds were down at point D at the 143.15 level, and now we've rallied the 3 basis points up to this level where we are now. Now, what's interesting about this is the fact that, we've had bonds rallying, and, the stocks have been also rallying, which, haven't been rallying much, but they're still rallying, and that is in itself unusual. I don't know if that's due to, people just pouring money, into stocks indiscriminately, which I think a lot of it has been happening, but something big is getting ready to snap here, because these things don't go in the same direction very often. and the flight to quality that we've seen through the years, has been in play for a long time. And the most amazing thing, when I listened to the news this weekend, because it's so cold here in Arizona, I was trying to get weather reports, and we got down to 22 here last night in the desert, and that is really cold for Tucson. And they talked about the fact that the Greek and Spanish and Italian problems that they had, they're no longer there. They are risk off. So there's really no problems now with Greece and Italy and Spain. So I guess everything is all right. I know they have 25% unemployment in Spain, but I guess things are much better, and nobody seems to be worried about it. Spanish debt has gone from a yield of, I believe, 22% a year down to 17% a year. That's really junk stuff, and but that doesn't mean anything if people want to buy it. That's the main thing that people forget to realize, is that when they're looking at that, it makes it really difficult, to understand. Now, I want to switch over for a second to the currency markets, because we had this tremendous move in the Japanese yen, and it's been a really a huge move. And I'm going to put two charts in. I'm going to put the first one is the long-term, the shorter-term daily one, and the next one will be the weekly chart, so that you can see the difference of where the yen has gone and where we are now, because we've just completed a major expansion up at this 180 860 level. We actually went 100 pips above that, which tells us the market is extremely bullish and it wants to go a lot higher. That's on the daily, but if you take a look at it on the weekly chart, you're going to see that this has been a tremendous cycle that has been in the Japanese yen for a very, very long time. I'm trying to get the last part of it done here, and you'll see that the rally that we've had just now in 2013 during the last 3 months of 2012 and 2013, that rally has been exactly what we had in January of 2011. We had a huge rally in the Japanese yen, and then it broke and went down and made new lows down at that 75 level, and that's when it completed the butterfly pattern. But there is a very, very strong 48-week cycle in the Japanese yen, and we are cresting into that cycle right now. So the strategy that I'm looking at is I want to watch to see what the first correction is going to be. I would like to see a nice AB equals CD pattern to come in the Japanese yen, and if it came in at the 382, which would be down around that 85 level, that would offer a very, very low risk opportunity, to be a buyer. That's the way that I would interpret that. Anyway, now the next one we want to take a look at because time goes so fast here, and this is, I think, relatively important. This was brought to my attention by the gentleman that called in from Philadelphia before John, and that is the relationship between lumber and the stock market. There's a strong correlation between lumber and the stock market. And if you can see when you look at this, the lumber futures are on the line chart, and then overlaid over that is the red line, and that is the stock market. And you'll notice that they're all completing these big AB, CD patterns, and they're completing it right near the end or the middle of the cycle. That was the cycle we just talked about. And if this is the case, we should be topping out in here in lumber and then also in the stock market. And so far that has happened in lumber. Whether the stock market has topped out or not, we're not sure, but we'll wait and see. But there's a high correlation here, and the patterns are completing together. So whether that means anything or not, we'll have to wait and see. We should have our answer by January the 22nd at the latest would be would be my guess. That's what I would be thinking it would be at the very latest would be that date. Now, one other thing that there's I'm trying to bring correlations in here because we have a situation where the currency markets bring a lot of money into the markets, and there's some correlations with stocks that are very, very positive. And one of them is the Australian dollar versus the U.S. dollar. When the Aussie dollar gets really strong, stocks stay strong. And what's happened with the Australian dollar is that it's made a quadruple test of the 786 retracement going back to last August at this 106 level, and has not been able to take it out. So there again, it's another divergence that we're looking at that, the Australian dollar should be making, new highs, and it's not doing that. It's actually coming into a great deal of resistance, and that's also another indicator to say you don't want to be, too bullish stocks up in here. Hey, folks, if this thing is a really bullish market, it's going to back off, and it's going to give you plenty of chances to buy it. Buying the breakout is, I don't think, the smartest thing in the world to do. If you go back and look at how many times, the market gaps up and doesn't fill that gap, you're going to be quite surprised that it's almost never. So you've got to be really careful, when you're looking at these, because they get very, 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 very touchy, as far as I know. Now, the next thing I wanted to get back into the tips, which are the inflation protected bonds. They've just completed a major bottom here, and as most of you know, that I'm very bearish on bonds. For the rest of the year, as soon as we go below 143 in the nearby Treasury bonds, which right now are March, I think we're going to be looking at a tremendous increase in interest rates, and it's going to surprise a lot of people, and you're going to see some real problems come up. And people, they don't realize this, but it's not the Federal Reserve that determines interest rate. It's the market that determines interest rates. The Fed influences it, but it's the people that are actually moving the money around. And of course, the Fed moves a lot of their own money around, which is our money. But that's neither here nor there. And but anyway, I really believe that this has got to end, this debt cycle. I know they talk about the fiscal cliff and the fact that we have to do a debt ceiling and raise the debt ceiling. Folks, that's no different than you being maxed out on your credit card and they giving you more credit. There is absolutely no difference between the two. And as you know, if you had a child that was maxed out on a credit card, the one thing you don't want to do is extend more credit to them. It's just not a good thing to do, and yet that's how countries are operating. Someday the musical chair is going to stop, and whether it's going to be this year or next year, no one really knows that. But eventually, someone's going to say, "Look, I just don't want to, lend out any more money for 30 years at 2.7%." And so that's why that's why you got to be really careful about lending money at these rates, at least for the other part. Excuse me, for the other part of the debt equation is who's you're going to lend the money to. Now, someone asked a question about Apple because in last week's letter I focused on Apple and how it related to Facebook and the importance of Apple holding the 512 level. And Apple, for some reason, I don't know what it was on Monday, but it gapped down below 512, and it went all the way down to the, hit 485 yesterday, and we rallied about $20 today. And I believe that's, just a snapback rally. We've had these before, and I don't believe that 485, is the bottom in Apple. I believe it's going to be closer to 395. If that's the case. Now, if the pattern changes, then I'll certainly, report about that. But frankly, nothing that I see right now makes me think that it's going to be, any different than what we see going on at the present time. Now, we have another market that is very, very close to making a major, major pattern, and that is the crude oil market. I know it's a commodity, and we'll cover more about crude and heating oil and gasoline tomorrow, on the show, but heating oil is right up near this $94.5 to $95 per barrel level, and it's taken quite a few days to get there. We bottomed in November, and we've been up 6 weeks very quietly, and we're going to be running into really strong resistance up in this level here, very close to this where we are now. We're a little above 94. So between 94.5 and 95, we should be running into pretty strong resistance at that particular point. So we'll see if that is going to happen. But we'll be watching that tomorrow, on the commodity show for sure. That's one of the things that we need to be watching. These are the things that that I'm looking at on a personal basis, because these are the things that we trade all the time. And we only try to trade only the most liquid things. And the next one I wanted to talk about, I jumped from gold. I haven't talked about silver yet, and I need to, talk about silver, because silver also, completed the 61% retracement. It's been nearly a perfect technical picture since last July. We've had several major rallies. Each one of them stopped exactly at the 61%. Or the 786 level. Each one of them was either a perfect stop, and I'm talking within a penny or two. And now, we've had a little bit of a rally here, but very, very small. The rally that we've had in silver has been just about $1 an ounce, which I thought it would be more than that. Gold has been able to rally more than $60 an ounce, but silver has rallied a lot less. I don't know if that's related to being more of an industrial metal or not, I'm not sure, but silver is not a good trading vehicle, because the liquidity in silver is 1/6 of what it is in the gold market. So you've got to be careful trading silver. It's a situation where you can come in and it's been a $2 rally, not a $1 rally in silver, which is it's $10,000, so that's quite a bit. It's actually, on a dollar-for-dollar basis, it's actually rallied more than gold, so thanks for correcting me on that. I really don't trade silver. I trade gold all the time, but I don't trade silver at all. Now, when we started the show, we were talking about the gold market, and we thought that gold had a chance, to get above this 1690 level, and whether it's going to do it today or not, I'm not sure. But if we can get gold above 1690, it's got a chance, a very positive chance, of breaking out to well over 1750 per ounce. And if you stop and think, we're at breakout levels in crude oil, and we're at breakout levels in gold. And we could be nearing breakdown levels in stocks because of all the gap ups that we have. So we're really at a real critical spot in almost everything that we're looking at. We focused on that in last week's commodity show, because we looked at the DBA. We've got to take a little break here, and then I will bring up the DBA, the ETF for commodities. 877-927-6648.
If you're an investor looking for a great weekly investment newsletter, then now is the perfect time to try out Ken Shreve's Ultimate Growth Stocks. Every Tuesday, Ken breaks down multiple sectors in his weekly newsletter, Ultimate Growth Stocks, with a full in-depth report including specific trading recommendations within his model portfolio, charts, sector analysis, upcoming economic data, along with intra-week trading updates on newsletter positions whenever the market dictates. Right now, you can receive a full month, that's 30 days, to evaluate Ken's newsletter free of charge to see if it fits your trading plan. At less than $75 per month, Ken provides you with his expert trading advice that can pay for itself in no time. Take advantage of this great offer by signing up for a 30-day free trial to Ken Shreve's Ultimate Growth Stocks today. Don't let this offer pass you by. Visit the front page of TFNN.com and sign up now.
with the launch of Tiger TV. TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, Ken Shreve, David White, Larry Pesavento, Victor Jones, or Daryl Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen, live during those shows, and have access to all those charts. You can test drive the Tiger's Den, absolutely free, for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's new trading newsletter, Patterns, Profits, and Peace of Mind. In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the forex market, and more. And you'll get the Technical Corner segment, which is a short but powerful weekly training session on trading. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you just the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 weeks. Go to TFNN.com and click on the free trial link at the top of the page. That's an $85 value, yours free when you register right now. Get Larry's Patterns, Profits, and Peace of Mind and get the edge you've been looking for.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Okay, we're back, folks. And I put in the Tiger TV chart area the chart for DBA, which is the ETF for commodities. We focused on that last week. And as you can see, it did stop exactly at the 61% retracement on this last move. And the move before it stopped exactly at the 50% retracement. So it was telling us that we were at some real critical levels in the commodities. And we were, looking at gold and also silver and wheat and corn and beans. And, we've hit some major support. We'll cover this tomorrow on the show, but it's important that these levels hold, because if they don't, that means that, we have a potential for deflation coming in. And I know nobody's expecting that. But if it does fail, then, you have to be prepared, because that's what happened in 2007. Now, also, I want to take up a collection today. I know a lot of you guys are, a big fan of, J.P. Morgan, and Mr. Diamond has been able to, get his salary cut by 50%. He loses, $4 billion or $6 billion. And instead of making $11 million this year, he's only going to make $5.5 million. Of course, if they have a good year, they'll give him an extra bonus, stock bonus of some kind. So this is typical of what happens on Wall Street, and that's really the whole thing that you're looking at. It's just Yeah, it's just amazing. There are very few people that are talking about the potential for deflation. I don't know the economics behind it. I just know the chart points when they start to break down. And, we are at a major, chart point in everything. Gold, silver, crude oil, soybeans, wheat, corn, all of them. They're all there. And you can see that in that DBA chart. Even though that's not everything, it's enough broad-based brush effect of showing you that these numbers have held. And they must rally out of here very, very quickly. Otherwise, it means it's going to fail, and then you're going to have some, potential for, deflation. But, I don't know. I just look at the charts. I gave up trying to figure out the fundamental part of this, and even having a master's degree in business that never helped me very much, because it's really what the price of the chart is telling you of whether there's buying on the upside and also selling on the downside. So that's all I really look at when I'm watching these things. I think we're almost finished here. I think. Well, let's see if I find one other one here that looks real interesting here. We'll find one. Here's one. This was the one from last week on Thursday. We were watching the gold at the 1652 level. That was the 50% retracement, and we thought it was going to come down. That's it, folks. Everybody have a nice day. Live every day in an attitude of your attitude, and may God bless.